Okay, we're live.
Welcome everybody. Welcome everybody. Come on, as y'all come on in. We excited. Make sure you got all your friends and family in. Where's the chat? All right, check in. Drop your name in the chat. Where you checking in from? So we can see. Drop your name in the chat. Give us one thing that you have learned so far. We want to know what you have learned. We are at week. Evan, what week we at? It's like, what city I'm at? Like I'm on tour. What week are we on in this Legacy Builder series? Good evening, everybody. I have no clue where my chat is, but that's okay. Did you all drop in the chat or refresh? Having luck seeing messages. Okay. Oh, is your messages working for y'all? Can y'all drop messages? Anybody? Can y'all drop messages? Where are y'all checking in from? I just need to see if the messages is working now. Good evening, everybody. Okay, there's a message there. Oh, it's coming down here. All right, where you checking in from, Tamika? Let's see. How do I? So I need to open up. Oh, I'm on the online browser. That's my issue. See, that's why we test all this up. Okay. All right. So it's not working up here, but it is working. Quick and A, Asher. Okay. Yep. Where y'all checking in from? We're gonna get started. How's the mic and the levels? Sound like we live. We got people online coming in. We're excited today for today's class. We got a special. Yep. All right. So it's working for people. I just can't see it on my computer. I see it popping up. So anyway, good evening, Dumfries and friends. I want to say, first of all, welcome back to Legacy Builders. We've been here. This has been something that's been very near and dear because we've been helping families protect what matters most, right? And what matters most is about how we build a foundation in this community that's not going to last today, but it's going to last for generations. That's what legacy is all about. So tonight is no different. We're diving into, I think, personally, and I'm pretty sure your guest speaker tonight is going to agree. But tonight, I think it's one of the most important parts of your economic mobility, your financial journey, understanding insurance. And I think you're in great hands because tonight our guest speaker, Joe, is the founder of Zircon Financial Services. It's a company that's dedicated to helping people pursue their financial goals and lifetime dreams. Joe has been doing this, believe it or not, for more than 30 years. Uh, for those who don't know, she's right here in the town of Dumfries, and she has built a reputation for giving trustworthy advice, for building those lifelong, lasting relationships with almost every client that she serves. Uh, what makes her extra special is she's a U.S. Army veteran. So she knows the value of discipline and being accountable and reliable. And she's brought that same level of service and care into her financial work. Her areas of expertise is budgeting, right? Because you need a budget. You know, if you don't plan how you're going to spend your money going to be gone. Investment strategy. She teaches how to really take and strategize where your money is going to invest. It's retirement planning, education funding, and tonight, well, we're going to talk about those insurance solutions. All of the things that she teaches focuses on families and it creates stability and growth. Now, I'm gonna tell y'all what I love most about Joe's story is that it's not just all about the numbers, because we can have an abacus, we can have a calculator, we can have all of that. But the fact that she's all about people and she really cares about people, her compassion, her energy, her passion for financial empowerment. If you ever have a conversation with her, you see she's very passionate. And those type of things are, what make her a true advocate for not just herself, but for her clients of all ages and all walks of life. And so whether you're on here today and you're just getting started, or you're looking to strengthen your plan, tonight is your opportunity to learn. So hopefully you're in a quiet space for the next 70 minutes or so, right, where you can take the opportunity to learn from one of the blessed. Please help me welcome the founder of Zircon Financial Services, Ms. Jo Powell. The floor is yours, ma'am.
Hello, everybody can hear me. Give me thumbs up or clap or something. Just make sure you can hear me.
Yeah.
No thumbs up.
Yeah, drop a thumbs up, fire emojis. Come on, drop a welcome our guest. Give our guests a warm welcome in the comments.
Okay. All right. Dale City's in the house. Got it. Okay. Well, thank you for the introduction. Again, I am Jo Powell. I am the owner, founder of Zircon Financial Services, and I'm glad to be here tonight. And I am promising you that I'm going to keep it simple. There's no jargon, no sales pitch, just real talk about what life insurance can do for you, what it does, why it matters, and how to make it work for your family or your business. I have an agenda that I'm going to try to cover as much as I can on the very basics of life insurance. But the main thing I want you to walk away with that it's just not a product for death. There's other things that you do, which I'm sure you got a taste of it last week, but I'll just break it down to the simple terms of how life insurances can work for you. Let me first go over the topics that I'm going to cover. Again, it's going to be what life insurance really is, term versus permanent insurance, how to calculate how much coverage you need, what affects the cost of insurance, using life insurance as your financial tool. And that's in everything. Could be from college to buying a house to getting a first car. Also, common mistakes on life insurance and how to avoid them, and how a claim process works. And then we will finish it up, tying it into how it should work with your wills and trusts. And then I'll open up to the floor for questions and answers. So with that in mind, we're going to jump right in. Okay, so let's start with the basics. What life insurance really is. Life insurance is not really anything about dying, it's about living. It's pretty much a promise to your loved one that if something happens, there's a backup plan to get through life or keep your lifestyle as is. It's a financial protection for your loved ones. It covers income loss, your debts, education, final expenses, and I think of it as love insurance. It's a plan for those you care about. So basically, if you have a breadwinner in the house and that breadwinner passes away, I know I don't want you to go back to work or I don't want you to do something different. You should be able to continue living your lifestyle the way it is if that breadwinner is not there. So a life insurance policy can help with that. It also can be, hey, you're max funding all your investments or your Roth or your traditional IRA, and you have extra money, you need to dump it somewhere. You can definitely put it in a life insurance policy because if you take money out, it's still tax-free. But we'll go into details of that. There are different types of life insurance. You have your permanent, and then you have your temporary or term. This is the most important part about life insurance because a lot of people get confused about it. The truth is, both term and permanent life insurance have their place in life, and it's always about when you need it or what's needed. So think of term insurance as a timeline, like 10 years, 30 years, 20 years. Might be a 30-year out there, might be a 40-year policies out there. But a lot of people think, well, why would I buy something that's only temporary? Well, you can match it up to your mortgage. Maybe your mortgage is for 20 years. And if something happens to you or to your loved one, the insurance can definitely jump in and pay the mortgage for you until the mortgage expires in 30 years. Or you have a student loan debt. Maybe you want to cover the insurance if something happens to you or to the payer of that student loan. You can just buy the time frame the student loan is outstanding, and then once the student loan is paid off, then term expires. Now, permanent coverage is lifetime coverage with cash value growth, which means you can pay your premiums, pay extra, maybe a dollar or two extra, and it continues to grow. And if you need to take money out for, I don't know, your first car, maybe a down payment on a house, and you don't want it to affect your current credit, that's another way you can take life insurance, the cash out of your life insurance to get what you need. Lifetime coverage with cash value growth is very useful for wealth transfer or retirement planning. Maybe you have two homes, but you have two rental properties, and maybe you have three children, and you want to make it even that each child gets the same amount. Maybe the first child gets to home number one, the second child will get the second rental property. Maybe the third child, you don't have anything to give. So maybe a life insurance, you connect them as a beneficiary. There's a couple of ways you can do that. By the way, if I'm rolling too fast, just hit me up with a chat saying that to slow down or go back or repeat something. All right, and next, if you trying to think of what's the best strategy to get either a term or permanent coverage, you can mix the two to keep your costs down. So there, you can get creative with the type of policies. A lot of people also stumble on how much should I take or how do I calculate how much insurance I should take out. But there is no one size fit all number for any type of life insurance. Usually you should look at your income, family debt, and your goals. If you have a number on those, add those together. That's a start. If you know the income of the breadwinner, maybe the combined income is 100,000 in the household or 50,000 in the household, you could start with that. Then on top of that, add anything that you want paid off. If someone were to pass, maybe the debts, maybe if you're supplying income to your parents, maybe you add that in there. And then the total amount, that's what you can start with. But there's a rule of thumb. It's usually take your income multiplied by 10, and that's your starting dollar amount of how much income you should start with. You can also take in consideration the total amount of mortgage, what's left. At least you know the house will be paid if someone passes away. Or you want to fund your children's education. Hey, I want my kids to go to George Mason. It's $80,000 a piece. So we got three kids, multiply 3 times 80, at least that's the bare minimum of life insurance. Or you can combine it with the final expenses, maybe just funeral costs. That's all you want to cover. Just the basic 25,000 just cover the funeral costs. You can start with that. But getting started is the important thing. If you ever wonder why your neighbor pays less or pays more for life insurance, it's all about the timing of your life. Age takes in consideration. The younger you are to purchase life insurance, of course, the cheaper it is. I believe in Virginia, you can go up to, I think, $1 million on a 6-day-old child, and it's like $20-ish. So starting young is always good. A lot of people will think, well, why would I get insurance on kids? Well, think further out. Starting off with the kids, you can lock them in at a lower rate. So by the time they get to an older age, the insurance is already paid for or it's in place at a cheap rate. It's just something to think about. You can also kind of wonder, well, let me go back. Your premium also looks at your lifestyle. Maybe you take out life insurance and now 2 years from now, you decide to race motorcycles. As long as you have the policy in place, the motorcycle is not going to affect your premium. But if you're a motorcycle racer and try to get life insurance now, it's going to be a little bit higher because of your lifestyle of, the risk that you're taking. The best time to buy life insurance was yesterday. And again, that's when you're younger, but it's never too late. Most insurance company will let you buy life insurance on an 81-year-old. So um, starting young is just, again, it's a lot, it's inexpensive getting it at a younger age. There are other statistics, or I should say status, that may affect how the premium works. Again, age and your health. There are some health risks that may not be insurable, but if you get it at a younger age, you're least likely to be, I want to say, sick or have issues. Tobacco plays a big role if you are a smoker. Yes, the premium is going to be a little bit higher. If you're a seasonal smoker, like say you smoke a cigar only when there's a graduation or a celebration of something, then it may not be so bad. Occupation could play a role. If you are a pilot of a aircraft that's, I don't know, you like do loop de loops and it's flies low or whatever it is, that may have a impact on it. Hobbies. I like riding motorcycles, so I made sure that I had my life insurance before I got into the racing part of it. And yes, I raced for 2 years. Um, the type of policy also determines the cost. So if you get a term insurance, a term is always going to be inexpensive compared to a permanent coverage because again, you're fitting into that timeline window. And if you are getting the term insurance and say you get a term insurance for 10 years, it's going to be relatively inexpensive. But if you flip over to the 11th year and you are up there in age, it gets really expensive. But again, working with an agent or a financial advisor, they can work with the numbers for you to make sure that you're staying in budget what you're trying to get. Also, the timing or the length of time. You can get a policy that will cover you to age 121 nowadays. Since medical technology is getting better, you can get a policy that can last 5 years or a year. So there are so many different sorts of policies out there that will fit your need and in your budget. Life insurance isn't just for protection. It can also be a tool building and preserving wealth. That's where planning comes into play. That last week, or last meeting, I understand that you kind of touched on different ways to expand your retirement plan through life insurance. We can do the same thing. I had clients who stumbled on a foreclosed home in town, and all she needed was a decent down payment, and she didn't have the money, not upfront, but she was able to take it out of life insurance policy. And by borrowing it from the life insurance policy, it has no effect on your credit or your debt to income, all the good stuff. It's there for you. It's just you can pay it back when you want to, but if you were to pass away and there's a loan out there, then the family will just get the remaining dollar amount of what's left in the policy, unless you're overpaying it. It also protects business interests. For example, if you own a business and say your partner is the main person that's bringing in your product or your production, you can actually put insurance on that person just in case that person passes away and you need money to fill the shoes of that person, or that person gets sick and now you don't have a disability income coming in. You can use life insurance for that. Or you can do a buy-sell coverage, meaning if a partner passes away, you don't want to kill the business, but you can use the life insurance to keep the business going. I mean, there's so many different ways that you can use life insurance for your business aspect. All right, common mistakes and how to avoid them. There are big ones. There are big mistakes that some people will purchase. Maybe a life insurance that's a C-rated company. A C-rated company means that the life insurance company may not pay when you have a claim, and they may just return your premiums back. So you want to make sure that you're conscious of an A-rated or even a B plus or higher rated company. Or I've seen clients buy too little coverage, meaning they'll get a $25,000 coverage, but they might have debt of, I don't know, 50,000 in the household. And the breadwinner passes away. Now you only have 25,000 to kill the debts, but it's not enough. So working with a financial advisor or an agent can help determine the dollar amount that's good for coverage. Some people wait too long to apply, meaning, I get it next year, and then next year you end up, I don't know, getting really sick where you're not able to get the coverage. So procrastination might be a deterrent of getting the proper coverage. Another mistake I've seen people will do, they will not name a beneficiary in the life insurance policy. By not naming a beneficiary, then it automatically goes to your estate. And if you don't have a will or a trust, which we will touch bases on that a little bit later, it opens doors for your creditors to come in and take some of your stuff. Yeah, I also seen people name the wrong beneficiary. I can give you a story of James Brown, who didn't update his paperwork, his will, and his beneficiary on his life insurance, and his fifth wife out of 8, I believe, ended up getting everything. So you want to be conscious of your beneficiary. And then perhaps every other year, go over the beneficiaries to make sure that you have the right one named. Another mistake, people will let their life insurance policy lapse. And when they lapse, that's usually when it's necessary or it's needed. So instead of letting it lapse, maybe there's a money issue or something of that nature. Sometimes you can call the insurance company and work out a deal. Maybe you can skip a couple of payments or bring down the face amount to cover the dollar amount that you can afford or something of that nature. But instead of letting it lapse completely, reach out to the insurance company and you'd be surprised they might can work something out.
Joe, you had a question. You had a question in the chat. Is it better to have whole life insurance over term, or which one is more beneficial? I think you touched on it, but the question is there, so I think they want a little clarity. Whole life or term, which is better, and which is more beneficial?
Okay, it really depends on your goals, but I do want to say, if you're getting term insurance for long planning, keep in mind only 2% of policyholders pass away during that term time frame, and 98% of the time you're going to pass away after the term expires. So your term is only for that timeline or that time frame that you're trying to cover. Whole life, yes, it could be a little expensive, but there's so many other products out there that still falls in the permanent category. It's always your best bet because it lasts the life of the policyholder. So it really depends on your situation, but just keep in mind that term only covers that time frame. So if you're going for a 5-year or a 10-year or even a 30-year, that the first year past that term, it is crazy expensive. It really is. So you might want to think about that. Or if you're just protecting that time frame, like your mortgage, if you only have a 20-year mortgage and you're not planning to refinance, then a 20-year term might be good to match up the mortgage. So it really depends on the situation of that person or that household. Did I answer the question? Yes, no, maybe. Thumbs up or something.
Miss Young, Mrs. Young? Yes, I think she's
good.
Yeah.
Okay.
Yes.
All right. Good. All right. Some people ask, what happens when someone passes away? What's the procedures on a life insurance policy? The beneficiary will file the complaint with the insurer. The death benefit will back up. Sometimes you can go to a funeral home and the funeral director or the person, the representative that's at the funeral home will execute the policy for you. sometimes I kind of frowned on that because then they get to see how much you are or how much the insurance is, and they tend to creep up the price a little bit. My suggestion is to file the person who is the executor of the estate or whoever the will named or the person in charge of family the family affairs should be the one to contact the insurance company. And then if the funeral director needs money to get things going, have the insurance company send the bill directly there instead of the funeral director calling the insurance company for you. It's just my thought. I hope that makes sense to people. And again, I'll open up for questions in a few minutes.
Okay, but
Um,
it was a follow-up question to when you said more expensive on the term and
okay.
the whole life. And it was like, when you say more expensive, are you talking about like a difference of hundreds of dollars?
Yes, difference of hundreds of dollars. Yes, yes. I'll give you an example. A term insurance could be, I don't know, $100,000 could be $300. Just picking a number, $300 a month for like maybe a 40-year-old. And actually, it's not even that high. Maybe it's about $100. I'm just picking a number. I don't have anything in front of me. But usually, if you get a term insurance like 20 years, you're paying $100 a month for a $100,000 policy. When you get to the next 11th year, which is outside the term, or the 31st year outside the term, it's like $3,000 a month. It's a significant difference between the dollar amount that you're paying for that term and then the dollar amount that you're paying after the term expires and you're moving into the next year or so after the term. So if you got a 20-year term, the 21st year, expect a night and day difference in premium. And it goes every year, it goes up. So unless it's a FEGLI, like a FEGLI insurance, which is federal group life insurance, then it goes up every 5 years. But it's always a significant punch in the jaw difference in dollar amount. I hope I'm hitting the dollar amount so you can understand how much of a difference it usually is. It's usually an extreme number. As I was saying, death benefits are paid. It's usually tax-free. So a lot of people will say, hey, Joe, I got plenty of money in my 401k and my other investments. Why do I need life insurance? Well, a 401k can be taxable to the person receiving it if you pass away. For a life insurance policy, the base amount is 100% tax-free. So if you get a $100,000 policy, you pass away, your heirs would get $100,000 tax-free money. You kind of can't go wrong with that. Same thing if you pulling money out to buy something or whatever it is that you need the money for, it's tax-free. The only time it's not tax-free if it's a MEC policy, but you have to put a lot of money in over top of the premium to get to that point. But again, your agent or financial advisor should be able to calculate those numbers for you. Also, when you have a beneficiary receiving money from a life insurance policy, it passes probate. So if you don't have a will or a trust, I hope that's not the case, but if you don't have those things, but you have a life insurance policy, the beneficiary will get the money usually right on the spot as soon as a death certificate is created. And there's no wait. You don't have to go through probate. You don't have to claim it. You don't have to do anything. It just hits right to the beneficiary. Doesn't go to a creditor, doesn't do any of those things. Unless you don't name a beneficiary on a life insurance policy, then it's a whole different can of worms. But the receiving person or that beneficiary life insurance policy, however you have it split up, those people that's named as beneficiary get the money right away. Okay, so with that in mind, I am going to open the floor up and ask away. Yep, ask your way.
All right.
Ask away.
So they said you got about 3 or 4 questions. Is there a way to get around the extreme amount difference between the whole life and the term? And can the term policy be canceled and you receive money from it?
Okay. All right. Let's break this down.
And then I think these all go together. Let me read the other question.
Okay.
They say what happens to the funds once a person outlives the time frame of a term policy. So I think all those will go together. You know, is there a
Okay.
way to get around extreme amount? Can the term policy be canceled and you receive money from it? And what happens to the money once a person outlives the time frame of a term?
Okay. These are great questions.
Yeah.
Okay, keep in mind term insurance. If you stop paying a premium, you kill the policy. There's no money to get back. If you outlive the term, there's no money to get back. So if you get a 10-year term policy and you live on, and you're very much alive in the 11th year, that's it. You don't get anything back. You don't outlive that. Someone asked if there's a difference between term and a permanent, the payment, the premium amount. If you're getting it side by side, getting it in the same year, it's not that much of a difference. But keep in mind, a permanent policy, there's cash value. So if you have $100 premium, you might have, 50 of it may go to the cash value. So you do have money that's built up in there. So if you have a permanent policy and you outlive the time frame of a permanent policy, which at one time used to be 100 years old, yes, you get the whole policy back at 100. But most policies go to 121. So people outliving your policies, not likely. If anything, you'll pass away first, and then the beneficiaries will get the money. For term insurance, you will never ever outlive a term, because once you go past the year, whether it's a 30-year, 10-year, 20-year, 5-year, 1 year, there's no money in, there's no cash value in the term policy. So you don't get anything back. You recover for the time frame of that term. If you cancel it, you can cancel it, but you will never get money back from a term. You may get money back from a permanent policy if you cancel it. You can also convert a term into a permanent policy. That might be a little bit cheaper as well, instead of waiting till the very end of that term and trying to convert. So say you have a 30-year policy, you're 15 years in, and now you have a little bit of money, you want to convert it into a whole life, or I should say a permanent policy, doesn't necessarily be a whole life. You can do that, and that will help with keeping the costs down. But term insurance, there will be no money coming back to you in a term. Even if you mistakenly lapse the policy, there's nothing coming back. That makes sense? Did I answer those questions?
Yeah, it looked like it. And then
Okay.
what is the max number of years you can get on a term policy? I think you answered that. Did you answer that, the max number of years on a
I
term policy?
think it's 30. I've seen 40, but that was like about 6 years ago. This day and time, they probably don't do 40-year terms anymore. And I know they were trying to do away with 30-year, but I think a 30-year term is still available. But I think they're trying to do away with it. The most common is 25-year term policy.
Somebody said, can you repeat and explain that payout scenario one more time so they can catch it?
Payout meaning how it works if someone passes away, how that works. Is that what you mean?
Yeah, I think Lisa, and you confirm if that's what you're asking. Yep, she wants you to repeat the scenario about the
Okay.
payout that you just gave.
So if a person passes away, first thing you should do is call the insurance company. I would not have the funeral director do it. I know your mind might be, oh, my loved one just passed away. My brain just can't work. Then assign it to another family member, but have that family member reach directly out to the insurance company. The insurance company usually will say, hey, do you need money for the funeral? We can get money to you within, I've seen it in 24 hours, just to pay the funeral costs. And then whatever's left, once the death certificate is given to the insurance company, they'll ask you, hey, you want a one lump sum check? Do you want to put in an annuity? Do you want money on the spot? I always say, take it as one lump sum and get with your financial advisor to divvy it out on how you want it. And it's 100% tax-free, coming from a life insurance policy. And if you die during a term insurance, you'll just get the face amount of whatever the term is worth. And if you have a permanent insurance with a cash value, you'll get the policy, the face amount of the policy, and then any extra If you didn't sign off saying that any extra turn it into more insurance or however the rider you picked, you're entitled to that as well. And most insurance company are pretty fast in paying. Once you put that claim in, and then as soon as you get the death certificate, you send it up. They're pretty quick. They're pretty quick. Providing you're working with a B plus or higher insurance company. That makes a difference. There are some companies that are C rated, and again, C rated, they may say to you, "Hey, I understand that the face amount was 200,000, but we're not going to give you 200,000. We're just going to give you back your premiums, and your premiums could be five premiums before the person passed. So you just have to be conscious of the policy that you're purchasing." Did I answer the question?
Yeah, looks like it.
Okay.
It says, how do you find
On
a
the
rating?
rating. Usually you can get the rating, Google the rating. Usually the insurance, Virginia has a toll-free number. It's the State Department of Insurance or Insurance Department of the state. It's a toll-free number, and you can say, "Hey, I'm calling just to get the rating of XYZ insurance company," and then they can give it to you right away. By law, they have to list it in the policy. They also have to list it when you're inquiring about insurance. It's supposed to be in their buyer's guide. So there's few ways that you can get it. Fastest way is Googling, and it'll come up because um, the state of Virginia, the insurance department, really wants you to know what companies are legit, which are C, C minus, A plus. They'll let you know.
They said, got it, thank you.
Okay. Okay. Any other questions?
No, that's all that was in there.
Okay. Now, when you have your life insurance, that's all good, but I can't preach this enough. You still need to get a will and you still need to get a trust. A lot of people are like, "Well, I don't have any assets to get a trust. I can just do a will." If you own a screwdriver, you own a shoe, you own a pack of chewing gum, you should get a trust. And the reason, a will is always going to put your personal information out for the world to see. So you're trying to be private, or you got some nice assets going on, you just have a will, it's going to be public information. And when it's public information, you're going to get the scam artists out there. You get the girlfriend that came from 20 years ago that always had a crush on your husband, going to come out the woodwork. They have the opportunity to do that. And a will can be contested at any time by anyone. For example, I had a client who just had a will, didn't have a trust, which I'll go with that in a minute. Had a Sprint bill going back to, I want to say, 1985. Probably some of you weren't even born at that time. And it was a $20 bill, but they tacked on an 18% interest for every year it was outstanding. So they tried to attack the estate, saying, "Hey, I'm going to contest the will because we want our bill paid going back to this year." Probate, they have to hear it, even though it didn't amount to anything, but it has to go through probate, and the probate has to argue it. It just prolonged the family to get anything. So in order to stop that, I always suggest to get a trust on top of that. A trust steps up the will, and it basically kind of shields everything that you can think of about your estate. It's not going to be public ties to anybody. You can't contest the trust. And a trust is basically putting your ducks in order while you passed away. You can still control who gets what happens. You can make sure it stays within your family. Like, you may have a trust set up and you got a daughter that you don't like her husband, but you want to make sure that your daughter's your money stays within your line. It doesn't bounce outside of the line. The trust will do that for you. A lot of people say, "Well, I don't want to spend money on a trust." Yeah, well, a trust can range anywhere between, I want to say, $1,000 to $3,000 with an attorney. It's so worth it. I rather spend that money to make sure that my assets doesn't bounce outside of my family into someone else's pocket, or I don't want somebody contesting that, I owe them money if I pass away and they're attacking my family for it. So a trust is just a step up from a will, and a trust is, it just locks in. It's like it buttons up your estate where no one can come in and take anything from your family. So life insurance is good because it does bypass probate, but if it's not attached into your will and your trust, it still opens doors for other people to see what assets you have. Just a thought. Um, I see you're typing away. I know you got a question for me.
What do you think is the biggest obstacle of people getting insurance? Why do you think the vast majority of people don't have insurance?
I think what crosses my desk, I think what bothers me, a lot of people say, "Oh, my family can fend for themselves," or "My wife can go back to work," or that's usually the biggest obstacles. My suggestion, uh, this is a time where we can really protect our loved ones and make sure that the next generation don't have to struggle like this current generation. Or it just makes your family a little more powerful by making sure that you have your leave assets to your heirs. Um, some people say, "Well, I don't have money for it." Well, I see you in a Starbucks coffee shop. If you can dedicate $5 a week toward your life insurance, it's something is better than nothing. So those are the two common things. Some people just feel that the next generation should fend for themselves. Um, I'm against that. I think I like my family to be as wealthy all the way into perpetuity. When my great, 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 great grandchildren, I mean, as far as I can see, can be just as wealthy going on, just like the Rockefellers or just like the Kennedys. The Kennedys make sure that their line always has money, and I think we all should be that way. Should now you put rules in there, rules like my life insurance and the trust can marry each other. And my father, when he had passed away, he had rules in his trust, meaning, listen, your inheritance will come in after you go to college and after military, and it can't be one or the other. It has to be both. So you can put rules in there if to make sure that things get dressed right dress going forward. But most people saying it's getting hard. It's hard getting started because money, or they just don't feel that the next generation should get anything.
There's a couple movies or TV shows that's a great example of putting rules in. One I think of is Brewster's Millions with Richard Pryor, right?
Mm,
Remember
mhm.
he had to spend $1 million in 30 days in order to get what was it, like 100 million or
Something
something?
like that. Yes.
Yeah,
Yes.
and he couldn't keep no receipts, and it was teach him the value of money. And then the other was a TV show that was on. I don't know if it was HBO, but it was called like Power. And the dad died, and the son didn't have access to the trust until he graduates from college. And so he has no
Yeah.
money until he graduates from college. And so those are two good examples of how you can
Exactly.
set
Yeah.
up that legacy and kind of control what people do in
Mhm.
that type of situation. So
Yeah.
somebody
I
said,
mean,
go ahead.
I've seen spouses are money happy, and soon as they get $1 in their pocket, they burn it up. So a trust or even a life insurance, you can dedicate, hey, they can only get 10,000 a year, or you can narrow it down to right down to depending on how they should spend it, or put rules in place if they're big spenders. Just a thought. Uh, it is recommended that you have two different beneficiaries, one for life insurance and one for a trust. It depends. It depends. It depends. It really does. It depends. Um, if it's set up right, the trust and the life insurance could work together with each other, but it depends on having different beneficiary. It really depends on your situation. Each person's different. It depends. But I tell you one thing, your executor of the estate should not be the same person as the person you're naming for your medical directive. Because if the executor of the state looking at your assets, they would be the one to put the pillow over your face to finish the job so they can get your assets. To me, those two positions should be two different people, if that makes sense. Any other questions? Well, I hope this is helpful.
This is helpful. Say it's helpful in the comments.
Mhm.
You know, as far as insurance, you know, is there a cost for not having insurance?
Absolutely.
Oh,
Absolutely. I'll give you examples of not having insurance. Had a client who kind of procrastinated on getting insurance. Wasn't a money issue, just I'll get to it. I'll get to it. And ended up being in a car accident. And he was the breadwinner of the house, not having insurance. The spouse, she was working, but it was nothing compared to the income he was bringing in. And they went from a house down to a studio apartment, and they're still trying to make it happen. So yes, it does make a difference.
mhm.
Uh, trust, that's a whole new class by itself. It's the trust is just a little more powerful than a will, is a step up. And there are some attorneys in this area who feel that, oh, you don't have any money, you don't need a trust. You need to fire that attorney. He tells you that. A trust is really, really something you really need. That's a whole new class, but I'm just touch bases on it to make sure to encourage you that you should at least have a trust. And if you're in the military, you have a will, and that's it. In the state of Virginia, that will is not strong enough. Just thought I'd let you know that it's just not strong enough. And again, anybody can contest the will. So um, I think go back to my friend James Brown. He had all those wives and forgot to update the will to his current wife, and not having a trust in place, everybody in the world was able to contest it. So I think he had 8 wives, all 8 of them contest the will. And what ended up happening, he had the court decided to divide his estate between all the wives. If you had a trust, that wouldn't have happened. The trust is what it is, and you can't contest it. So just a thought. Just a thought.
That's good. People say yes, very extremely helpful.
Okay.
You know, very helpful, helping me with a plan.
Mhm.
It's good. As far as protection, so with term life, our money does not appreciate. We just lose our money in the term.
Well, I wouldn't use the word lose because you were protected during a term time frame. So you get a 10-year term insurance. During a 10-year, you are protected. It's just the 11th year, you're not unless you jump into, that high premium. So insurance is not meant for like investments to get something out of it. Term insurance covers just that. Think of it as when you go to work, you have your group insurance, your group coverage. If you quit, the group coverage goes away. It's the same thing with a term insurance. It's just you're covered for that term. And when that term expires, that's it.
Mm. So you talked at the beginning, you said that insurance is not just for protecting you, but also building financial wealth.
Yes. So not so much the term insurance, but your permanent coverage. You
Permanent.
can,
And there's
you can,
different types of permanent.
yes. But you know what? Term insurance could protect your wealth because if you pass or if a breadwinner passes away during that term insurance, you still have tax-free money coming into the household. Or say you're on a budget, say you can only do $50 a month, but you need coverage, bigger amount of coverage. Start off with term just to get the coverage going. Then as money gets better, maybe the 10-year term of 100,000 may work. And then next year you convert maybe 10,000 of that 100,000 into a permanent coverage. And maybe the year after that, as money grows, you can start converting it. So term insurance could be your starting point. It's better to have something than nothing. And then you can always convert a little bit at a time. And then when you convert term insurance, you don't have to go through a physical and all the good stuff. So if you start off with term insurance and you're out there racing a motorcycle or jumping out of planes at a decent height, or skydiving, or even doing deep diving without an oxygen tank, get that term insurance first, and then you can convert it. And it doesn't matter what type of activities you're doing.
So,
To
so
the
somebody
parent
said
kid.
this is news to them that a trust actually going to trump a will, and they want to know why isn't this common knowledge?
Because most people think you have to have a lot of money to have a trust, and it's a lot of attorneys put that in your head. Most people, and I want to say Virginia being a Commonwealth state, the Commonwealth states, I think it's 5 of them, still have that ruling. If I come in and pay your interest on or your taxes on something you didn't pay for, like land, usually they have the right to confiscate it from you. So I think because of that concept is still in the Commonwealth state, it's not common for people to advocate to get a trust. I'm advocating to get the trust, especially if you have a lot of assets. Get the trust. Also, the trust keeps your assets from being passing. Keep a trust will keep your assets from going into death taxes or inheritance taxes. It bypasses through probate taxes. The will do the same thing, but it still opens the doors for other people to do the contesting it. Someone asked, should a parent get permanent insurance on their young child? Yes. Term insurance to me doesn't make sense in a child, and I'll tell you why. If you get permanent insurance on a child and then you look at the term insurance, the premiums are probably the same or very close to the same. So why not get the permanent insurance where it lasts forever compared to the term insurance that's only going to last for 5 or 6 years. And then after the 6th year or 10-year or whatever it is, it goes to a higher rate. Where a permanent insurance, you're locking in that premium and it doesn't go up, but it covers the child up until the age 121. I hope that makes sense.
So this is good because of the fact that now the biggest difference what I'm hearing between term and whole life is on whole life you accumulate what do you say, cash value that you can actually
Yeah,
borrow on.
but I wouldn't say whole life, say
Oh,
permanent
not whole life.
insurance.
Permanent
Yeah,
permanent
permanent
insurance. Not
insurance.
whole.
There's like 6 or 7 different types of permanent insurance, but yes, but permanent insurance will always have some sort of cash value in there. So if you cancel the policy, usually after the 3rd year, there's some sort of cash value that comes back to you. Usually about the 3rd or 4th years when cash value starts building up. If you cancel a policy, usually in the first 3 years, there's not enough cash value to build up in the policy, and you probably won't get anything back.
So this is a common problem people have is they have kids with special needs. Like I just had a friend who lost a daughter to sickle cell. And so attainment life insurance, what are other options? Now, I can tell you what I've heard, and you can tell me if this is true. If we come together and we get the Dumfries Community Foundation, that they can create a group policy, and that if they're 70 or under, they can join our group, and there's
get
no
the insurance.
okay.
Can't do that. Unfortunately, that's illegal to do
Oh, that's
that.
illegal. Okay,
It's
so
illegal to create a group just to get insurance. That is illegal.
so you can't create the group just to get insurance, but if you have a group created, everybody
Correct.
in the group can get insurance. So the purpose of creating the group.
The purpose of creating a group can't be for the purpose of insurance.
Got it.
Okay.
All right, so how do you
Now,
help people with special needs? Yes.
so those that have special needs, or a couple of things. The parent usually can get a rider on the insurance policy that covers children, and even children that haven't been born yet. Once a child is born, then automatically the insurance will cover them. That's one way to do that, because we don't know if a child's going to have special needs or not till after it's born. So I always encourage, hey, if you plan to have children, you're getting life insurance, get a rider that says all children born to you will automatically be covered. So that's one way to cover an event that a child has special needs. Another thing, life insurance on special needs, yes, you're right. Depending on the circumstances, it may be difficult to get insurance on a special needs child. So in that case, you may have to go a different route. You may have to set up an annuity based where you're paying a premium in something, but it builds based on that dollar amount that you're putting in. You may have to go just different options of getting the insurance. Also, you have to pay attention if that special needs child is getting benefits from the government. You have to be careful because there's some benefits coming from you to the child. The child may be in jeopardy of losing the benefits from the government. So that's something you may have to work with a financial advisor or agent to kind of work around how to get coverage on a special needs child for so they wouldn't lose benefits, or you can get coverage on them. I hope that answered your question.
So now I think the $1 million question, since we opened up this window, what is group insurance?
Group insurance is an employer that offers insurance to employees. And usually there's no physical or anything that's needed. It's called a dirty pool. That's a terrible word, but basically it takes the average ages of all the employees and the average smoker and non-smoker, and then create a premium dollar amount, and then the employer supplies the insurance for the employee. That's group coverage. That's in a nutshell of what it is.
Is
So
that was Walmart sued for that?
I don't know. What was the circumstances?
It's a class action in Florida and another state for taking their policies out on the employees that was hired without their knowledge or something like that. And
Well, that's illegal.
yeah,
If you can't take out a policy without a person knowing. I've seen people who are divorced and say, I'm going to take out a policy on my husband because my ex-husband, and if he passes, the money will come to me. But he still got to sign off on it.
mhm.
Yeah. So yeah, that's illegal. That's illegal.
Okay. Okay. Were there any other questions tonight? Any other information I know you wanted to touch on, maybe briefly what wills and trusts you said?
Oh, I thought I did. So how about anybody have questions?
Okay.
Can ask me.
How can people reach you if they want more information? If there's a way to drop your information
Yep.
in.
Evan, if you want to put my info up on the screen, so I can get my information. Evan, or Ray,
Yeah,
or
it's uploading.
okay.
Oh, definitely. Okay. Give it 1 second.
So the cue
Okay,
card
there.
in the middle works. And the Q card will also get you a way that you can, if you need to get on a calendar, you can do that as well. Do that. And the phone number that's there, it's textable, so you can send a text. But when you send a text, please put your name in there because the way it comes in, it just comes in to say your name and you met me through this, and here's my question. You can do that as well.
So I do have a wealth question.
Mhm.
If you can share an example of how like your clients might use insurance to reach some type of life goal. I know you help with education and retirement or even starting a business. Like how do they use it while they're kind of like alive for something like that? Can you give us an example or story?
Okay. Like a person has a life insurance policy and I got an example. This this rift that's going on in the world with everybody's losing their position as a government employee. Some people are using this opportunity to jump out there to start their own business. And starting your own business, they need money from somewhere. So they can pull money from the life insurance policy and start the business. Or I have another client who's a government employee but not getting paid, like those people that are in essential positions, but they're not getting paid until a month or two down the road. They can use the life insurance policy to kind of offset the income. And then once the income starts back up again, they can replace the dollar amount that they borrowed from the life insurance policy. Is that what you were thinking?
Yeah, I'm just thinking about not even also that. I know there's some different supplemental type insurance, but I'm thinking like we talked about the permanent policies. Like how do people take money off to pay off school or start a business or something? I know we talked about, the trust telling people what to do, but how do they, what's their plan for, say a kid about to graduate high school, how do they pay for their college tuition and stuff like that?
Okay. Well, if you were my client, I'll be telling you to spend 1 hour a day or 1 hour a week on a Saturday going to a book store and applying for scholarships. I'm encouraging that all the way around. Apply for a scholarship and apply for those scholarships that are you least likely think that you would not get, like golf or bowling or I had a client get a full scholarship on bowling because nobody else applied for it. So that would be my first thing. Second thing, I'm I will say to get started for school, you can use life insurance, cash value to pay for your school. Hopefully that's not your last, that should be your last resort because there should be other plans in place for school. Starting a business, same thing. And just to get started, and then hopefully you can replace that, put that money back in. Or if you're opening up your life insurance and you're overfunding it for college, you can do that too. But there's some other things out there that's a little bit better than trying to overfund a life insurance policy to pay for school. Did that answer your question? Was that helpful?
Yes.
Okay.
And I probably said something that people might not know. What are the supplementals? I know we talked about permanent term. Did we talk about supplemental insurance?
Like
Uh,
supplement, like
like in
this.
some commercials with that little duck on TV and stuff like that. What is that?
Okay. Okay. There are other insurance supplement, I guess could be disability insurance. You got
Okay.
short term and long term. You have long term care insurance. Long term care basically can cover if you go into a facility, and a policy can cover that, especially for Alzheimer's. Those policies are helpful because that's probably the most expensive care that's needed. Disability insurance. There's so many different supplement coverages. There are policies that have these supplements built into it, like most permanent coverage, permanent life insurance coverage will say, hey, if you are diagnosed with a terminal illness and you only have 24 months to live, or you are in a some sort of car accident or something of that nature where you only have 24 months to live, some insurance companies will let you take out up to 50% of the face amount. So you've got $100,000 policy, you can take out 50,000 tax-free and spend it on whatever you want or pay your medical bills or whatever it is for your last few years of your life. You can do that as well. I mean, there's so many different legs of insurance out there. And some of your major companies, life insurance company, have these different legs on there. Like your long-term care could be a part of your life insurance policy. Your disability could be part of it. Your accidental health or your health insurance coverage, or even cancer policies might be attached to a life insurance policy. So there's so many different stuff out there. And again, working with a financial advisor or an agent, they can actually pinpoint everything that you're trying to accomplish, and then you just give them your budget and they'll try to make it work. Did that answer the questions on supplemental?
Yes.
Okay.
Yes. There's so many different insurance out there, Joe. I mean, how does someone know what kind? I mean, because everybody has different stages in their life.
That's correct. So for me, when I sit down with a client, I start with your goals first because I need to know the end result. What's the end state you're trying to accomplish? And then from there, I work backwards. And then working backwards will determine what's the best policy or what's the best supplemental thing that you need to get to the goal that you told me about. And I've never, ever, ever, ever had a client not reach a goal. So even if you think that goal is so far-fetched, if you plan right, you'll make it happen. So that's my thought.
So after tonight's session, right? And say somebody already has insurance, what's the first thing they should check on the policies that they have after tonight's?
Beneficiaries, make sure you have your beneficiaries are updated. You don't have the last ex-wife on there, or you named a person who had already passed and that person's still your beneficiary. Take a look at that. Second, if you have a term insurance, be conscious of when the term expires and how much it will be after expiration date, how much the premium jumps up going into the first day after the expiration date of the term. Cash value, permanent policy. Take a look at to see what other riders are attached. There might be riders you didn't even know existed, like a waiver premium rider, which is common. A waiver premium says that, hey, if you break your arm and you're not able to work, you can call it in and the insurance company will pay your premiums for 1 year. I mean, there's so many riders on there. So I say just pull out the policy, look at the first 4 pages of the policy, usually break down what you have, and then you can take it from there. Is that helpful?
Yeah, very much so. Very much so. Well, how often should families kind of like review and update it, or are there life events that kind of trigger those type of reviews?
Yes and yes. Clients of mine, I try to go over everything every annual review. And critical events, yes, it usually triggers, and that's usually where they find out that the wrong beneficiary is listed on something. So I always say you go out for Valentine's Day, you go to dinner, and it's always a longer wait than normal because the restaurant is filled. This is the time that you talk about your goals. Have you reached them? Have you updated your beneficiaries? Those are the things you might want to talk about before that dinner comes out. I don't know, maybe do it on your anniversary, or maybe every 15th of the month of August. That's where you sit down and make sure things kind of go over. So with my clients, I try to do it annually when they come in for a review. And that's what we do. Make sure beneficiaries up to date. Make sure the trust is correct. Make sure your assets are related to the trust. All of that good stuff. And somebody asked me, do I promote critical illness insurance? It really depends on the person. So general asking, it depends. It could be yes for one and no for the other. So it depends on you.
It's so many different agents out here. How can people, especially in our community, make sure they're working with someone who is
that's a great
trustworthy,
question.
who really is going to look out for their best interests?
That's a great question. If an agent is just an insurance agent, I shouldn't say just insurance agent, if that agent only works in the insurance field, you can always call or reach out to the Virginia Department of Insurance and call and say, hey, have this agent or the agency had any complaints or issues? That's one. Another way, a person who is licensed not only in the insurance world, but also in the finance world, is a website called brokercheck.com. Brokercheck, BROKER, check, 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 brokercheck.com. And when it pops up, you can put the advisor's name in there. You can use me as an example. Go to BrokerCheck. It will ask you individual or firm. And for my case, you can put my full name in there, and it will pop up all the credentials or all the complaints, which I don't have any, but everything you want to know about if I'm a decent person or not, it's listed for you. So hopefully that answers your question. But brokercheck.com is how you can check a person who's licensed in the insurance world and in the investment world. And then the Department of Insurance of Virginia, where you're just checking an insurance agent without the other securities license.
That's good. I got a fun question for some of that personal wisdom, right?
Mhm.
Because you served in the military and you work with people probably in all walks of life.
Yes.
You know, what have you learned about financial confidence that everyone in this room should hear? You know, you can give us some wisdom and some insight on that confidence that people should walk away with and have.
I'm just gonna be real with you. In
Okay.
this day and time, there's not going to be a middleman income or middle person. Either you're going to be wealthy or you're going to be poor. It's just how this economy is going. So my suggestion is get your ducks in a row, because we all want to be wealthy, and think of the next generation. Keep them wealthy, because the government is only supplying stuff for the poor or for the wealthy, and the middle man is getting left out. So if you have to pick and choose, I'd rather be on the wealthy side than on the poor side. So hopefully that answers your question. That's what I'm learning. Also, if you can dedicate and paying yourself first, bills are always going to be there, but think about you. Start with $5 a month. If that's all you have, that's all you have. $5 a month. It's better than nothing. And you just get started. My youngest client is 7 years old.
Oh,
Something
wow.
like that. And you just start out small. And that 7-year-old probably can easily retire at age 50, easily, with no problem. Start out small. You don't need a whole lot of money to get started. Start out small. Do $1 a week, and then advance to $2 a week, or start with $50 a month. And if that did upset the budget, then bump it up to 65 or something like that. Just getting started. You should be priority. Your bills will always be there, but you should pay yourself first.
I think that's good. That's all I got. Let's see, was there any other questions? Any save rounds? Any save rounds? Any final questions? It's military terminology, right?
Mhm.
Any final questions from y'all? Let's see what we got. Excellent. Come on. Give me 3 people to write down one takeaway you got from today's lesson. You can take the slide now, Evan. Let's give me 3 people to just drop. What's your takeaway from today's, right? Because it's again, it's not what you know that makes you who you are. It's what you do with what you know, right? So give us 3 things. Give us 3 different people to give us 3 different things that you learned tonight. Drop it in the comments.
I trust is better than will. Excellent.
Uh-huh.
Converting my term insurance. Excellent. Excellent.
Come on.
I need to get a trust for my kids and family. Okay. That's perfect. Permanent
Permanent
statement from whole life. Yes.
Mm.
Whole life falls under permanent insurance, but there are so many different permanent insurance out there. Whole life is one of many. Jennifer typing away here.
Come on. Who else learned something? Name somebody in the
Yes,
different medical
yes,
director. Yeah,
yeah, yeah.
this is good. Somebody is helping somebody else learn. Come on, each one teach one. Who else learned something good tonight? Drop your golden nuggets. You had some great enabling learning objectives tonight. That's good. Was anybody else typing? Let's see. Anybody else learn something? Listen, in the comments, y'all, please let's give our lead insurance instructor on tonight's lesson, Insurance 101. Y'all give Joe a round of applause in the comments. Put your round of applause in there. Thank her
Thank
for
you.
sharing
Thank
one,
you.
her time, right? Because you pay one way or another. You either pay with money or you pay with time, right? And so it's a yes, yes, thank you. Come on. And so her time, her wisdom, and her years of experience have been invaluable. This time she spent, she can't get it back, but she has invested it in you. She reminded us tonight that insurance isn't just about preparing for the unexpected. It's about planning for what's possible, right? And so we're excited about everybody who's going to start planning,
Yes.
and it's about protecting what you work so hard for and using it wisely to really build the kind of stability and opportunity every family deserves. And so, what I hope that you take away as we continue this legacy series is that your legacy isn't something you wait to build. It's something you start building right now. Let me say that again. It's not something that you wait to build. It's something that you start building right now. I think I wrote in the comment earlier is that today is the youngest you're ever going to be again for the rest of your life,
That's true.
right?
That's
And so
true.
today is the
That's
youngest you're
true.
ever going to be, and so it's no need for you to not begin to take action. You're never gonna feel ready because ready is not a feeling. Ready is an action. So you're never gonna feel ready because ready isn't a feeling. And so I want you to take what you've learned. I want you to go out if you already got an insurance plan to review your plans. I want you to ask the right questions and make sure your family's future is secure. And next week we're going to continue our legacy building series. So we thank you all for showing up week after week. All of those are growing with us. This is a very important thing that I think we're doing for our community. Most communities, as you see, and I'm gonna share some. I'm gonna share some stats. Can I share some numbers with y'all real fast? If it's okay, say yes in the comments. If it's okay, if I share some stats with y'all about what's going on in our community. Uh, okay, good, good. Over the last 10 years, right? Most stuff is measured in decades. So from 2014 to 2024, Dumfries has grown in population by 20%. So just the incorporated town of Dumfries, we were roughly a little bit over 5,000. Now we're over 6,000. That's 1,000 people increase in 10 years. In that same time frame, watch this, Joe. The cost of housing from 2014 to 2024 in the town of Dumfries has went up 109%. So that means $150,000 house in 2014 now costs over 300 plus $1,000 in a 10-year time frame. Prince William County, the houses grew at a rate of 56% in the same 10 years. So that means Dumfries, the housing prices in the town of Dumfries has grown at a rate that's almost double the county and the state in the same 10-year period. What does that mean? Why am I telling y'all these numbers? The population in Dumfries, we have in and around Dumfries 5 housing developments planned over the next 5 years, where our population will grow in that 5-year period another 20%. Why is it important to build houses? Because you have a supply and demand. If the supply is low and the demand is high, what that does is that drive your housing prices on. I don't know why I'm teaching this tonight, but
It's okay.
right?
It's okay.
And so you're driving the cost of housing up. And so this economic mobility, this legacy series is important to me, is because I don't want to price you out of Dumfries. I want you to grow. I don't want to gentrify you. I want to be proactive in your economic development and you learning financial wellness and financial health, right? This series is not a mistake that we're teaching you insurance, that we're teaching you wills and trust and all this other stuff. It's a part of a very important initiative on how to economically empower our community, so you're not trying to move all the way past Spotsylvania. Like, you're not driving south to find stuff that you can afford. Because as the housing prices go up, those people that are renting, guess what's going to happen to your rent? Your rent prices are going to go up, and you're going to get pushed further and further away. And so as I study the numbers, right, it's my job to be forecasting as the chair of your council, as the visionary, as the one who sets the agenda. I have to look at the data. I have to measure where we're at, and then I have to be able to forecast, right? I know some of y'all who worked on y'all masters didn't understand why you need to take managerial accounting or project management. I hated those classes, but you needed it to get your master's degree, right? And we see why forecasting and looking forward is important as you begin to project and see where we're at. And so, I just want to encourage you all to take action, right? I say it every single week. Look at what you've learned, begin to review what you have, and begin to take action. Reach out to these experts who we're bringing in week after week to really pull into them. You got 30 years worth of experience, 30 years worth of mistakes, 30 years worth of clients that they dealt with, lessons learned that you can pull from. And so your scenario isn't unique to what she's seen. So I said a lot. I don't know if I went on a tangent, but I just want you to know why this economic development is important and why this legacy building is. I want to thank you all for showing up. I want to thank y'all for continuing to grow with us as a community and being part of this community. I'm committed to helping our community build stronger families, helping us build brighter futures. And we're doing this one Wednesday at a time. What I do want to ask is, everybody, are you okay with us extending this an additional 2 weeks? How many of y'all would like to get additional information? I want to extend an additional 2 weeks and move the graduation. Oh, wait, the answer. Okay. I want to move the graduation to, okay. I want to move the graduation to Tuesday, November the 18th. Tuesday, November the 18th. So we'll add 2 additional sessions, bringing some good information. And the goal is I want to have a working session where you actually begin to fill out, those who don't have wills done, to fill out a basic will, and we get that filed and notarized on site that day. So my goal is for 100% of you who've been participating, especially I think on day one, only one person had a will, but everybody to walk out here with a will. And if you all commit with that, I'm going to provide some type of stipend or grant to help pay for that. That's my commitment to you, to give you a grant for those who want. How many here want to have your will done by the time you graduate? Let me see. If that's you, say me. I just need to know. If that's you, say me in the comments so we can identify who wants to have their will by the time that in their class. Okay, Joe, I think this is back. So my commitment is to get a level of stipend or to help pay to have these wills done by the end of this class. So we'll bring in a will working session and have people fill out, and we'll look to get that notarized. So that's all I got. Joe, I'm going to give you your closing remarks as anything closing as we get out of here for the night.
My closing remark is just, I thank you for taking the time out to at least sit and kind of learn something. And it's never too late to get started. My oldest client recently passed. She was 104 and she was still kicking it. But it's never too late to get started, and think about yourself first. And I'm right here in Dumfries if you have any questions. So that's all I have.
That's it, everybody. Thank y'all for coming out. Good night. God bless.
You want me to walk down the hall to see you there?